part of your question with regards to closure of EBOs. So what we are doing is we are rationalizing some of the EBOs in some of the malls into conversion of SS Beauty stores. So this is with the objective of improving efficiencies, both front end and at the back office level. So, for example, when you have 4 or 5 EBOs, and when you have a large format SS Beauty coming in with a better, beautiful experience with much more powerful brands, we feel that integrating it into the larger universe of SS Beauty is a better customer experience, and also at the same time, in terms of efficiencies, we get better efficiencies. So that's the first part of the question. Having said that, we are not shying away from opening EBOs in newer malls, because we believe that the true brand expression for certain brands in terms of strategy comes from the EBO. So it's a combination, right? We close some, integrate it into SS Beauty. We are also open to invest in EBOs depending on the new areas and new malls. Now, in terms of the ROC, we are talking about 15% to 20% to start with, and eventually moving up to 20% plus. This is normally the calculations that we work around. And for SS Beauty, what we have also seen is that our SPSF has improved over a period of time, and we are 50,000 plus in the second half of last year. So it is clear that the strategy is working, where we do better, bigger SS Beauty and integrate and bring larger, bolder brands into the whole universe of beauty. Because what we are trying to embark is to rewrite the unwritten rule of presenting beauty in the most glamorous way, where customers get pampered, and this all revolves around the experience part of it, which we think is core to our strategy. Now, coming on the capex, yes, normally beauty stores have got a higher capex. This is basically because most of the brands insist in a way not to compromise on quality, because the Indian consumer is a very discerning consumer who is looking at experience that is not short of UK, Singapore, Dubai. So we definitely ensure that the quality of fixtures are very high, and in many cases we get it imported, and also the particulars in each and every product of the fixtures is dictated by the brand, because these are universal brands or global brands, and hence there is a higher capex to start with. But with scale and with time, we always try and find ways of rationalization, which means that effectively when you open a first boutique, maybe your capex is on a higher side, and then you get rationalization coming up to 15 to 20% eventually when we have scale and when we have better workmanship from local market conditions. I hope I've been able to answer to your point.
Sure. Thank you so much, Viju.
Thank you. Next question is from the line of Resham Jain from DSP Asset Managers. Please go ahead.
Hi, good morning, team. So I have just a couple of questions on Intune. So given the experience of last 8 months, can you help with the overall kind of economics? How do you think will work out in Intune and the payback period? And also compared to Shopper Stop, the ramp up of a store in terms of reaching to desired level of revenue per square feet, how much time does it take? Is it faster or slower or similar? That also will be helpful.
Sure. Thank you, Resham. I think we already clarified in the deck. So let me start with the economics. Currently, I think our mature stores are consistently hovering on in north of 12,000 as far as sales per square foot on an annualized basis is concerned. So that's the start point of the economics. We've clarified that our delivered margins would be in the range of 36% odd. That incorporates discounting, aging provisions, everything accounted. So that gives you your gym rock, so to speak, right? Kavi just mentioned in his opening address that we've done a lot of optimizations on the CapEx front. So the CapEx comes down to somewhere around 1550, which is, even if I say so myself, fairly benchmark worthy. So that takes care of the CapEx. All the OpEx assumptions are in line with what a value retailer would end up doing. With this SPF and this margin, we will turn EBITDA positive in the first year, which is what we've seen in the stores which are nearing a year of operations, right? So do I answer all the economics-led questions that you put on the table?
Yeah, qualitatively, yes. But what will be the payback period you're looking at?
Yeah. The payback period would be about 2.5 to 3 years.
Okay. Fine. Thanks. And sorry, one more question is on all the new stores or incremental stores you are planning in like outskirts of the city kind of stores, tier 2, tier 3 cities. This is how you are looking at?
We've clarified in the past that I think as far as Intune goes, we will follow a clustered expansion approach. We've identified markets where we want to go heavy in the first year, and we will continue doubling down on them. That doesn't mean we will completely shut down on opportunities outside of those clusters, but the overall focus will remain in those 8 or 9 markets.
Okay, perfect. Best of luck. Thank you.
Thank you. Next question is from the line of Gaurav Jogani from Axis Capital. Please go ahead.
Thank you for giving me the opportunity. So my first question is with regards to the overall CapEx plan that you have highlighted. So the 250 to 270 crores, does it factor in the Intune stores being opened organically and not on franchise?
Yes, Gaurav. It includes all the CapEx, Intune, normal departmental stores, beauty doors, plus renovation, plus any CapEx on tech or warehouse. It includes everything.
So there is no assumption of franchisee store in this, in the CapEx guidance which we have given.
Okay. And sir, just a related question on this. I mean, because Intunes we will be having our own inventory, and I'm assuming an inventory of around 3 turns of around 3 to 4 months. So what kind of additional working capital requirement would be required because of the increase in the Intune store format and also some bit of the private label part?
Let me answer the first one. On the private label, we discussed in detail. We have already reduced the inventory. We expect the inventory on the private label between 14 and 16 weeks, and probably we may even come down. I mean, that's the effort right now. We are fairly confident. I mean, we are between 16 and 17 right now, and we should come back. On the Intune, again, we are between 12 and 16 weeks with just 22 stores opened. So with the additional stores, I do expect the working capital in terms of weeks should come down probably between 12 and 14 weeks. So that should be the ideal number, Gaurav.
Yeah. So my question was in the absolute terms, because we would be adding roughly around 60 Intune stores, and that would then envisage another additional inventory that we need to store. So given the 250 crore capex that we are, looking for and the additional working capital, would we suffice with the internal accruals to match the same, or we might need to raise some debt for it?
We have done the overall cash flow for FY25. When we presented the budget to the board, we did the overall cash flow for the FY25 also. See, we have 150 crore line of credit with banks, and in addition to that, we have 350 crores line of term loans with the banks. When we completed the cash flow, including the working capital, what we need for Intune, it seems that we should be able to manage within the working capital of lines that has been given to us. As of now, we are not planning to borrow anything other than the working capital limits, Gaurav.
Sure. So that's clear. And so my next question is on the beauty distribution business. I mean, this year you have done the revenue of around 119 odd crores, and the EBITDA is also positive. Fast forwarding it to a couple of years more, say by FY26, 27, Any guidance that you can give on the overall business shape and margin profile for the same?
So, distribution is still a very young business, and we have entered into a very saturated market where there are already traditional distributors who have been in the domain for the last 15, 20 odd years. We are forecasting next year to double this current run rate. We intend to reach around 250 crores. And what was very important for us is to be EBITDA positive from year one, because this is something that gives us a lot of confidence, reaffirmation that we are in the right business. Even though it's a saturated business, we have started with some very powerful brands. This is also to do with the fact that Shoppers Stop has got the legacy, has got the credibility in the market to be a long-term player. Now, to tell you, for the next 3 years approximately, we're looking 250 crore going up to 400 and 550. But the fact of the matter is distribution revolves around brand associations and partnerships. So obviously, we can look beyond that, but for the moment, we would like to be conservative and to give you something that is absolutely achievable. And we can reconfirm that this business also adds a lot of value within the Shoppers ecosystem, because you have visibility and it gives you confidence to invest. Because we think that beauty is something which is here to stay. A horizon of 3 to 5 years is important because the beauty landscape is dramatically changing, and we think that this adds a lot of value and we get visibility end to end, which I think is very important from a perspective of a long-term investment. Another important element to mention, we have embarked on the journey and we have been quite fortunate to crack some very powerful brands, luxurious brands. But given the fact that India, the belly of India, beauty is in the masstige segment, we are quite confident and we are moving into the masstige segment. So next year we will see quite some interesting masstige brands being onboarded, which is something also to ensure that we have the full assortment from luxury, lifestyle, prestige and masstige. So that's the direction. It's a strategic thought, and then we are on track to achieve what we think is appropriate.
And sir, what about the margins? I mean, are high single-digit margins possible in this business, given it's a distribution format business?
So Gaurav, let me take that question, Gaurav. See, I think Biju just now spoke. Last year is the first full year of operations, and we were EBITDA positive, and we want to be continue to EBITDA positive. So the margin should be in the range of between 7 and probably 9%. That's the range we are expecting it right now. To answer the question, that should be in a high single-digit margin, Gaurav.
Sure, and so that would be like possible once you reach that 400 crores or top line by year 3. Would that be the right understanding?
Probably in year 4, and year 3 would be slightly lower than that, and in year 4 would be the numbers what you're talking about, Gaurav.
Sure. And so the last bit on the expense part, the other expenses and the employee cost for this quarter, if you look at it on an absolute terms, the employee cost was flattish on a YY basis, and so was the other expenses. One, as you rightly mentioned in the starting of the call, that given that the business scale was lower and hence these expenses were managed. So how should we look for both of these going ahead in terms of forecasting?
So Kavi spoke about in detail on the overall expenses even for this fiscal. Last year, during the quarter 4, on a like-to-like basis, the expenses are almost flat. This year, as we start, we want to have a like-to-like expenses of probably a half the inflation, between 2 and 3%, and any new stores obviously will have the additional expenses, Gaurav. So to answer your question, we want to be absolutely keep the cost in control, because the market is still there is a slowness in the market, and once the market improves, then we will start investing on marketing and other areas.
Okay. So my question was more actually on the relative terms also, because even if you compare it versus Q3, though I understand it not right comparable because it's a festive season. But I mean, overall, the cost was really down. So, is it because that we have taken some cuts in terms of marketing spends or some clawbacks, so not clawbacks, I mean, some cuts basically across various line items that is leading to this, and probably once the business recovers, we can see this going up again?
Yes, more, I would say, large, yes, Gaurav, because we did, as you rightly said, we reduced the investment in marketing. Even in some of this, like on the employment cost, as the slowness were there, we did not invest in the people because we want to get the higher productivity. So, yeah, if the sales growth starts as per plan, then we will start investing on the people.
Sure, sir. Thank you. That's all.
Thank you. Next question is from the line of Sameer Gupta from India Infoline. Please go ahead.
Hi, sir, and thanks for taking my question. I have two. Firstly, the inventory write-off of 9 crores this quarter. Just wanted a little more information, little more elaboration on this aspect. When do we typically write off? And is this sold in the depletion channel? And I mean, if this is something that is part of the normal business, is it likely to repeat? You know, some typical qualitative aspects around this inventory write-off.
Sameer, again, Kavi clarified that in this speech. See, last year was a challenge for the entire retail, particularly for men and women western wear. So that's the reason where we also had some one or two ranges what we purchased earlier that did not go well, and that's one of the reasons where specifically two brands where we had a higher write-off of last year. Our inventory policy is very clear on the fashion. Anything more than 1 year, we start writing it off, and by end of the second year, we write off the entire 100% of the inventory. To answer your question, second question is will the inventory write-off will be the same for FY25? It will not be. I mean, it will be significantly lower. That will be the normal whatever that happens in a year, say, I would say 1 or 2% of the total private brand sales. That would be the normal write-off. That will be there for FY25. We don't expect any higher write-off on this year. To answer your second question, on the inventory that has been provisioned, we sell it as a scrap to maintain the freshness in the shop floor. Like there is a process involved within the company. So all these inventory are sold as a scrap.
Got it, sir. Second question, and I heard in the opening remarks that there is an expectation that consumption environment is at least there was a confidence in the voice about the consumption environment improving post-elections. So just wanted to understand what would be the drivers here. I mean, and if March is so good for you, why is it that we have to wait till like the elections for actual recovery to start?
It's a great question, Sameer. So yes, March was very, very good. April also, the first 15 days have been outstanding. Once the elections have started, and I think the mixture of election and the heat wave which we are all witnessing, there has been certain markets where, there has been slowness. For example, typically when an election happens, and so in the month of April it has happened on 2 Fridays. In the month of May it will happen on 2 or 3 Saturdays as well, right? So what happens is, when you do that, the stores get shut for the entire day, and obviously there is a hit because retail, as you know, is all about driving things very, very, minutely. So that is one. Second, what gives us the confidence? So what we are seeing right now is, if I look at the overall business and how we have been phasing over the last 1 year or so, a lot of our business has been focused around making the Shoppers Stop as a premium destination, premium omni-channel destination. I think Biju spoke about a lot of good work which is being done on beauty, which is clearly showing us results. We have identified certain other categories which we are focusing on in terms of premiumization, whether it is sunglasses or watches, handbags, footwear, where we feel that as we change the brand mix, the reason for the customer to come to Shoppers keeps on increasing because we provide an exclusivity and a product which is not available readily in the market. I think the biggest thing which is happening as we speak is that we have been able to put so even in case of apparel, we have seen that with the kind of mix which we are building on, we are seeing a great positive movement in terms of the growth. So I think the apparel story is back after a long time. After a year, we are seeing that consumption in apparel is going on better. So I believe that once the market's steady and then no disruptions external, the stores are open throughout the days, months. I think there's a great story happening there. Just to give you a data point, and I think it's very interesting, when we were looking at and we talked about opening of stores in tier 2 markets, we have opened around 5 stores in the month of March. 3 of them were in tier 2 markets, tier 2, tier 3 markets. What we are seeing is that even in those markets, the consumption of premium and premium plus brands has increased dramatically. What is happening is that as we are opening these stores and they are becoming mature, we are the destination for the customer in those markets. So what we are saying is it's a function of overall category mix changes, but even the entry of newer markets and as those stores become more and more stabilized going forward, there is a lot of traction which we are getting. So we become the choice of customer for buying premium brands across categories, and I think that's a clear differentiation we have got. And I see as the market stabilize, we getting an outstanding over-index result from the consumers.
Very, very clear, sir. Just a follow-up, if I may squeeze in. So FY24, being a tepid environment, we still saw 15 department store additions. Let's just say FY25, if we assume that the recovery is slightly delayed or, things don't go as per plan, are we going to change our department store addition targets, or that still will continue irrespective?
No, so as I mentioned, as you enter into a new city, you start gaining market share because you were not present there, right? Sort of the 15 stores which we have planned in the coming year in FY25, 10 are in completely new cities. So it's a netted addition for us as increasing the customer base, making penetration higher, getting connection with the consumer. So I think we are at this point of time, we are very, very confident of sticking to our guidance, which is 15 new stores in departmental stores and around 60 Intune stores as new stores.
Got it, sir. And this funding via internal accruals, you are assuming that SSS growth and hence the EBITDA performance of the existing stores will improve, and hence the internal accruals will be able to fund store additions, right? Is that understanding correct?
Absolutely correct, Samir. I mean, there is no doubt about that. In fact, even last year, it has been largely funded from internal accruals.
Got it, sir. That's all from me. Thanks again for answering all the questions.
Thank you.
Thank you. Next question is from the line of Shalini Gupta from East India Securities. Please go ahead.
Good afternoon, sir. Just 2 questions. We just wanted to check, next year also we are looking at some kind of gross margin reduction. Is it so?
No, Shalini. We are not. In fact, the next year the gross margins should improve.
Should improve. Okay. How much should we budget for? By 100 bits?
Normally we don't give such guidance, Shalini. Since you asked me the question, I have answered that.
Okay. And so my second question is, if you can please explain, one of the lines in the presentation you said, GAAP PBT includes one-off of rupees 24 crores in other income on account of reversal of ROU liability. So this much I've understood, that there's a reversal of liabilities, but then you're also talking about 6 crores in exceptional income. So if you can just please explain this.
So, Shalini, I will explain this, but what I will also request is, we have given a note number 5 in the notes to in our press release. There are 2 aspects. One, on the income, we have a store in Pune which we closed. It was a 21-year lease. Because it's a 21-year lease, we created the ROU asset and the ROU liability. You are aware that ROU liability will always be higher than the ROU asset. As we are in the process of closing the store, the excess ROU liability with this ROU asset is what we have written off. That is around about 24 crores. On the exceptional item, as I said, if you refer to point number 5, there is a loss of 5.7 crores on impairment of property, plant and equipment on the right to use assets. The Indian GAAP is very clear on the impairment testing, and based on that we have impaired 3 stores where these 3 stores are not profitable post allocation of expenses, and that's the reason we have impaired this 5.7 crores. Any further questions?
No, sir. Thank you.
Thank you.
Thank you. Ladies and gentlemen, that was the last question of the day. On behalf of Shoppers Stop Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you.
Thank you.